Hello, and welcome back to another Sigma Max investment video. So, today I'm going to be talking about the uranium sector. It's something that I think is a really great investment. I mean, nothing is investment advice, but it's just something that I've kind of um, been looking at a lot recently. Been in it for a few years. Just wanted to discuss my thoughts on it, and put my share my thoughts out there on the internet. So yeah. As always, disclaimer, following content is for educational and informational purposes only and reflects my personal opinions and insights. It is not financial advice. I'm not a licensed financial advisor, and nothing in this video should be interpreted as recommendation to buy, sell, or hold any financial asset. Always conduct your own research and speak to a qualified advisor before making any investment decisions. Investing involves risk, and you may lose money. Past performance is not a guarantee of future results. Following content is for educational and informational purposes only and reflects my personal opinions and is okay. So let me start by this. The uranium market is highly cyclical. Okay, this is what I love. It's my bread and butter. Cyclical industries. They're so easy to, understand. It's just supply and demand. So we look at this chart here. We're potentially in the third bull market. I mean, look at the past 5, 6 years. Look at the stocks of uranium done very well. So yeah, so we had a bull market in Jan 73 to 78, and if you look at this is just the price per pound in dollars. So yeah, obviously during this period we have a lot of inflation, but they were up 629% in 5 years, which is, it's a lot. In the bull market too, this was the last bull market and the one that everybody kind of talks about most and goes back to. This was kind of in the early 2000s, peaked around June 2007. Prices of spot uranium were up 1,801% over 6.5 years. And I think we're in the bull market three. This is only to December 22. Right now, prices are about $81 per pound. We did get up to about 100 last year, just in the spot market. But look at how high uranium got in 2007. This was what like one 130, almost $140 a pound, and you know, look, something I always remind people is we have to account inflation for this. I mean, if we go by the CPI, it's going to be high even, but look at if we denominate it in gold terms, it's going to be through the roof, in the next cycle. So yeah, I still think we're really in the early innings. Um, and the reason why I love this so much is because this is just a spot price. So if the price of uranium goes up 1,800%, you know, look how much leverage uranium miners have to that. All they have all fixed costs, and then if the price of the thing that goes up is, 1,800% more, they're winning. It's kind of like gold miners. At the minute, the price of gold is really, really high, but the price of oil is really, really low. So their fixed costs, their operating costs coming down and they're making more money because they're selling the price of their gold for way more than they would normally. So yeah, it's really, using leverage in terms of the miners, they have a lot of leverage to the spot price. And yeah, so what causes the bull market in uranium? So it's just a supply and demand story. So, there's a supply and demand imbalance in terms of the amount of uranium needed to operate reactors around the world compared to what's being mined. So there's a lot of reactors being built. So globally, there's 60 reactors under construction, and most of those are coming online before 2030. So a lot of these are being built around China, India, countries like that. And so, you know, at the minute we have a supply and demand imbalance already, you know. So how are we going to fuel those reactors? So it's estimated that you need 180 million pounds kind of to fuel those reactors. And in 2025, it's expected that only 125 to 130 million pounds will be mined. So, where's that other 70, 75, sorry, where's that other like 55, 60 million barrels, sorry, pounds of uranium going to be come from? You know, it's it's a supply demand imbalance. I mean, so yeah, we have a 50 million pound deficit if we go by these numbers. So yeah, this chart here shows the reactors being built around the world. Um, so in China, they've got quite a few under construction. Um, and yeah, like, you know, developing countries, they need energy. I think, nuclear reactors are the best way to get energy. You can argue however you like, but it's clean energy. You know, if we mine it, it's cheap. And also for utilities, the price of uranium really doesn't make much of a difference. It's such a small part of their costs that they're kind of price insensitive. Justin Hume from Uranium Insider talks about this a lot. So a lot of utilities are going to be renewing contact contracts, long-term contracts over the next year, 2 years, and they want to lock in uranium so they can ensure they get the supply because they know that a lot of supply isn't there. As I said, there's going to be a 50 million pound plus deficit. So yeah, but there's something to keep in mind is that, you know, like anything, mining is hard. So delays in mining projects could further exacerbate the supply-demand imbalance. So if we look at this year, Kazatomprom, which is the largest uranium miner globally, and they account for 23% of global production, they've actually had to cut their estimated production in 2025 by 17%. So and that's due to them not having enough sulfuric acid, which is how you extract uranium from the ground. But, you know, that's a big proportion of the uranium not being mined. And, it could even be more, like who knows? And Cameco's the second largest producer in the world, which accounts for 12% of global production. And yeah, they're based in North America. And Kazatomprom is also based in Kazakhstan. I just thought I'd mention that due to you know, obviously tensions are tight between the US and Russia, or the West and Russia at the minute, because Kazakhstan's kind of an ally of Russia. So I think that's something important to bear in mind. And at the minute, the US has actually sanctioned Russian uranium. So there's no uranium coming from Russia, which is taking off a lot of the uranium. So yeah. So there's also a NextGen, which is a Canadian company. They have a Rook I project in Canada, which is expected to be the most significant uranium mines globally. So this is expected to produce 30 million pounds of uranium, which is going to be 25% of the current global supply. And, even though like I think this is going to be a great mine, like, I'm invested in NextGen, I'll say, but there's potential for delay in the regulatory approval and scrutiny from government regulators, which could also lead to higher prices. So, as I've said previously, many utilities are going to be renewing their long-term nuclear contracts in 2025 to ensure stable demand for their reactors. So, because Russia, they're no longer going to be able, North American utilities are no longer going to be able to get their um, supply from Russia. The US only produces 1 million pounds of uranium, so they're going to require 40 to 50 million pounds from somewhere else around the globe so they can ensure that the reactors stay running. So, I kind of want to draw this back to, so my investment philosophy is, you know, asymmetrical opportunities where I can generate higher than average returns. I'm looking for opportunities where I can sit and wait in something and expect superior returns relative to the rest of the market. And I think this is a great example of this. So in the past uranium cycle, this is all rough work, but you know, if you were to have a 100K portfolio and you invested 15% in the uranium sector, I'm definitely a lot more than that in my personal portfolio, but let's just say 15%. And I'm just going to say Cameco is a conservative example because it's easy to measure. But if you were put a bit into some more speculative names like Paladin, things like that, you would have done. oh my God, you would have made loads more money. But let's say in 2002 you put 15% of your money in. By 2006 to 7, and say the rest of your portfolio remained unchanged, 75k is just the exact same, or sorry, 85k, then the rest of the Cameco would be worth 250k. And as I said, if you invest like a percent of that in Paladin, it would have been a whole nother story. It'd been way more. So I think this is a good example, by holding for 4, 5, 6 years, this is the kind of returns people experienced in the last bull market. So some of the key takeaways for this, it's such a simple setup. It's more of a when, not if. Um, you know, I've been in this for years already, like since 2021, 2022. Um, but I think there's a supply and demand imbalance first off. That's the story. There's growing nuclear demand around the world. Reactors are under construction, and utilities need to renew contracts, which is likely to push up the spot price. So yeah, as always, none of that was financial advice, guys. It's just my thoughts, and I'll share. I think there's a really good piece written. I don't know who it's by, but I'm going to put a link to it in the description. I think people should read if they're interested in this. And it basically is called "Could you have held on to your uranium gains" or something like that. And it's basically this guy. He's written all about the last bull market and the kind of signs. So you were up loads at one point and then down, and that's kind of how I see it right now. Like we were up, um, you spot price was at like $100. Now it's down to about 80 or so. But yeah, it's such a volatile sector. So this is so normal if you read about the last cycle, and to really hold and make the gains, you have to have conviction in the trade. So yeah, that's it for today, guys. I hope you enjoyed. And yeah, thank you for listening.